Should I refinance my mortgage? I'm going to give you the tools and information you need to answer this question for yourself. Let's get to work. What's up, friend? I'm Kay Scholl. Welcome to another financial awareness video. If this is your first time here and you want to improve your daily financial decisions, grow your wealth and financial literacy, start right now by subscribing and clicking the bell so you don't miss anything. Today we're diving into the topic of refinancing the mortgage on your primary property, the place you call home. By following these 4 simple steps, you will be able to decide if it makes sense for you or if it doesn't. And stick around for the end because I've got a few tips and ideas on how to make this a smoother experience for you if you decide to pull the trigger. Step 1, decide your refinance goals and objectives. How will this refinance benefit you in your situation? You have to start with the why first. Otherwise, as you navigate through this process, you won't really have the best answers until you understand why this is good for you. Step 2, gather your information. These are simple, hard facts, very easy to find. Number 3, make your best educated guess regarding a few of these other things. And then step 4, run your own numbers and come up with your own conclusion for yourself. Step 1, decide your refinancing goals and objectives. How will this refinance benefit you in your situation? If you don't start out with the why first, you're going to fumble through this process a little bit and it won't be as enjoyable or as fun. Are you looking to lower your interest rate, lower your monthly payment? Are you looking to shorten the life remaining on your loan? Perhaps maybe you are 4 or 5 years into a 30-year fixed and interest rates have dropped so low that you could refinance to a 15-year fix and keep your payment the same, if not possibly even lower it. Are you looking to switch from an adjustable rate mortgage to a fixed rate mortgage? Are you shifting from an FHA loan to a conventional loan? Are you going to be pulling cash out of your equity of your home? If so, what are you going to use that cash for? What's the driving motivation behind doing that? And how does doing that align with your personal financial plan long term? Quick side note, when I mentioned the making of this video to my mortgage broker, he wanted me to add that you should have some general knowledge around market conditions. Market conditions around 2 specific areas. 1, what's the real estate in your area look like right now? Are prices going up? Are prices going down? Are they somewhat stable? Are you in a good area? And then number 2, mortgage market conditions. What's going on with interest rate these days? What's going on with banks as they process your loan applications? So take some time, do a little bit of research on your own so that you can be financially aware of this process you're getting ready to jump into. Step 2, gather your information. These are simple, hard facts for you just to gather and understand. How much is your home worth? Jump onto Zillow.com or Realtor.com or download either of their apps, and that will give you a ballpark range. Keep your expectations in check, though, because through this application process, your lender is going to hire their preferred third-party property appraiser, and they will do a professional subjective appraisal on your home, and that's the number that really matters in this process. Give your bank a call or give your lender a call or hop online and make sure you know what balance you owe on your mortgage. And when you do that, find out what your interest rate is as well and confirm if you have an adjustable rate mortgage, how much does it adjust by each year and what are the thresholds that it could go up or go down. Good for you to know that information. Make sure you understand how many years you have remaining on your current mortgage. Did you start off with a 30-year fixed and you're 3 or 4 years into it? What will you be refinancing to? A new 30-year fixed or possibly shortening the term and jumping to a 15-year fixed? Side note, I will be doing a video on which mortgage is best for you, 30-year fixed versus 15, conventional versus FHA, so stay tuned for that. Also, make sure that you know what your credit score is. If you're not happy with your credit score, check the link down below. Just recently did a video about how you can improve your credit score. Good information there. Step 3. Make your best educated guess about what this refinancing is going to cost you. Generally speaking, it's about 2% of the purchase price, but set your expectations accordingly because it very possibly could be higher than that if there are some closing cost expenses that you're just not aware of, or if you might add a point or two to the new loan to buy the interest rate down. And then also, answer this question. Will you be paying for these closing costs out of pocket, or will you be wrapping them into the new loan balance? Make sure you have answers to both of those questions. Do you know anybody that is a mortgage broker? Fun fact, did you know mortgage brokers love referrals? If you've had a very good experience with another mortgage broker you've used in the past, strongly encourage you to refer them to your friends, to your family, to your coworkers, because as you invest in that relationship, it could pay off for you. Maybe they might be able to get you a reduced interest rate or smaller closing cost, but that's only true if you have a good relationship that you've invested in with them. Shout out to my boy Patrick. Most importantly, make your best educated guess on how long you'll be living in this current home for, or how long you'll be owning this current home for. This is huge because if you decide one day to make this property an investment property and become a landlord, how will this new loan payment impact your cash flows and what you think you could rent this property out for? We'll cover that in future videos where we discuss long-term financial planning and non-correlated assets. Do you anticipate having a career change or a job relocation where you might have to move out quickly? If you have to move out quickly, can you rent it out quickly? Can you sell it quickly? And then also, how will this new payment impact your monthly budget? Link in the description down below about how to make a budget. And then also, if you do decide to rent it out, how does that play a role and a factor in your long-term financial planning? These are all great questions that you should be asking yourself. If you find any value throughout this video, hit that like button. That one simple action by you will result in helping someone else become more financially aware so that they can make smart, educated decisions about their finances. Step 4, run your numbers. Now, we'll go over some examples in a moment, but generally, hypothetically speaking, if this is going to cost you $6,000 to do this refinance, but it's going to save you $250 a month, your break even is 2 years or 24 months, which is why you should have already answered the question, how long do you anticipate owning this home for? If you will be owning this home for longer than 2 years, sounds like it might make sense to do the refinance. We're going to try to keep this short and sweet. These are 3 mortgage refinance hypothetical examples, and these numbers tell a story. So let's jump in. 24 Maple Drive has no PMI. As you can see, their appraised value compared to their mortgage balance is quite strong. $377,000 of equity, very nice. From these figures that we are seeing right here, we could presume that this 3.875% interest rate was based on a 15-year fix that was taken out 4 years ago. Now, their new mortgage, they actually are increasing their mortgage from $202 to $240. So we can clearly see that they are taking around $38,000 of equity out of the home. They are lowering their interest rate from 3.875 to 3.5%, but they're stretching their loan now from having 11 years left to now a brand new 30-year fixed. Not really sure why they would be going deeper into debt and stretching it out for a longer period of time. So we don't have the full picture here, but they are going from $1,731 to $1,078. So their monthly cash flow is going to be much better, which is why their break even is only 8 months. 5876 Park Place. Now this home has PMI. We could derive from these numbers that the $132,000 appraised value is probably not what it was 2 years ago when they took this 30-year mortgage out. 2 years ago, 4.65% was not a great interest rate. So seeing that they are going from 4.65 to 4.2 tells us that they might have improved their credit a little bit. And they also have seen a little bit of appreciation in their property value. So one of the reasons why they might be refinancing is to lower their payment, because they also are removing PMI as part of this refinancing process. You do not need to refinance your home in order to remove PMI, but that certainly is part of the picture here, because they're going from $627 to $489. They are also keeping their mortgage balance the same from $100,000 to $100,000. So we could also presume that they are paying the $2,000 cost out of pocket instead of wrapping it into the mortgage. So again, we don't have the whole picture here, but as you can see, these are some of the scenarios. 8389 Rocky 3 Road, great movie if you haven't seen it. Appraised value $265. Looks like this home was purchased 3 years ago. We can maybe assume 3 years ago it was worth $250,000, which is about the national average, give or take. So their current mortgage balance $214, and as you can see, their new mortgage balance is $212. So they actually are coming out of pocket not only the cost of the refinance, but also a little bit more money towards the principal balance. We can also assume that they are going from a 5% interest rate down to 3.75. So one of the main driving factors with this is maybe over the past 3 years, the people that own this home have probably improved their credit, because 3 years ago, 5%, not that great. So going to a 3.75 in 2020 is a much better interest rate. They also are going from a 27 years remaining on their 30-year fix to 25. So this particular situation is a little bit more telling because they're shaving 2 years off their mortgage. They are also removing PMI, and their payment is going from $1,252 to $1,131. So the break even isn't as good, but as you can see, they're being charged a smaller interest rate, and they shave 2 years off of their loan. Now, bonus tip, if you have seen the video this long, if you happen to have extra cash, I have researched this a little bit, and I believe the ballpark number is around $10,000. And if you want to chunk $10,000 towards your existing mortgage balance, you don't necessarily have to refinance. You could recast your loan or do a re-amortization. You want to call your bank or your lender specifically to see what their thresholds are, but food for thought, if you're just looking to lower your payment and do a re-amortization, you do not have to completely refinance your home and go through all of those costs and appraisal values and working with the mortgage broker. You could just simply pay a big chunk extra towards your loan. Although this video contains topics of refinancing your mortgage and personal finance, your personal financial situation is just that, personal. By no means is this video intended to be financial advice for your unique and personal situation. Here are a few quick tips to consider as you are going through this decision process of whether or not this might make sense for you. Most mortgage refinances are called cash out refinances, where you're pulling cash out to pay off your old mortgage balance in order to get a new mortgage. Make sure you understand what other debt obligations you have and what you owe on those debt obligations and what the interest rate is on those debts, because you might want to consider pulling more cash out and paying off that other debt. I have a buddy of mine who did exactly that. And after paying off all of that debt and wiping out those monthly payments, when you compare that to his new monthly mortgage payment, he was able to save $834 a month. So run your own numbers and possibly take that into consideration when you're doing this refinance. If you're watching this video and you haven't filled out the mortgage application yet and you do decide to pull the trigger, here's the best thing I can tell you to do. Get organized now. Make a file on your computer and put all of your documentation there, because then you'll be organized, it'll be in one spot, and it will make the uploading of those documents online very smooth and easy for you. You're going to need a number of things. 2 years of tax returns, the last 2 months of bank statements, 2 recent pay stubs. You're going to need your homeowner insurance policy statement. You're going to possibly need an HOA stub if you're in that situation. You're going to want to be aware of what your credit score is. You're going to want to make sure that if there's anything strange or unique in your checking or savings statements that you provide, that you are able to explain those things or provide documentation. If you are a business owner or you're 1099, you might need to also provide your P&L year to date or for the previous year. So make sure you get organized, and that will help this process go very smoothly for you, and it will be a better experience. If any of this video has been helpful for you, share it. And if you've been talking with anyone about refinancing your mortgage, text them this video. They might appreciate it. Hey, thanks for your time. Leave a comment down below with your mortgage refinancing tips or questions you have for me. Thanks. Go live your best life.